This episode is being brought to you by the dental event of the year, the 12th annual Dental Success Summit, set for June 12th through 14th, 2025 at the beautiful Omni PGA Resort and Spa in Frisco, Texas. Join us as some of our profession's top educators deliver world-class tactical and strategic knowledge to help elevate your career, your business, and your personal life. This year, we've added educational tracks to provide value for your entire team. We're also thrilled to announce our phenomenal keynote speakers, Ryan Holiday, multiple New York Times bestselling author and one of the world's most respected purveyors of ancient Stoic philosophy. For more information and to register, just go to truedentalsuccess.com. That's truedentalsuccess.com. Can't wait to see you in Frisco. This episode is being brought to you by our great friends over at Profi 2020 Dental CPAs. Profi is a full-service dental CPA firm that provides monthly bookkeeping and managerial accounting services. They offer a company guarantee to deliver financial reports by the 15th of each month, or that month is free. They have a proactive tax team dedicated to serving growth-oriented dentists across the country. Profi was created to change the mindset of dental practice owners and help them to understand the importance of current, usable, accurate data that can assist with strategic business decisions. On a personal note, I can 100% endorse Profi as my CPA firm of choice. The 4 years that I've been with them have been the best in terms of organization and implementation of advanced strategies to decrease my tax liability, as well as offering top-notch IRS audit defense. If you'd like to get started or learn more, schedule your free financial x-ray and get half off the onboarding costs for being a listener of the Dentalpreneur podcast. Just go to profi2020.com/DSI. That's PROFI2020.com/DSI.
The Dentalpreneur Podcast. Okay, doctor, it's time to put down that handpiece. You're listening to the show dedicated to helping dentists get their lives back. It's time to decrease your stress, increase your profitability, and regain your passion. Now introducing your host, Dr. Mark Costas.
Hello, everyone. Welcome to another episode of the Dentalpreneur Podcast. I'm your host, Dr. Mark Costas. Hey, friends. I hope you're doing great out there today. Oh, man, this is a great afternoon. I've had a lot of great conversations today, but this one I was really looking forward to. Today, we are welcoming back a multiple time guest to the show, and he's back by popular demand because every time he comes on the show, we have a spike in listenership. Last time, I think it was over 8,000 people that listened to our last episode together. Today, we're going to welcome back Brannon Moncrief to the podcast. He has over 20 years of dental experience as a banker, broker, and sell-side advisor. For the past 13 years, Brannon has served as the CEO and principal at McLerran Associates, which specializes in providing sell-side advisory to large practice owners seeking a DSO affiliation or private equity partner. Brannon, welcome back, buddy. How you doing? It's great to see you as well. I mean, geez, it's hard for us even to stop talking, just to flip the switch on the mics just to get recording, because you and I have so much to talk about. So our little pre-chat was a great preamble to what I want to talk to you about today. First and foremost, the last time that we spoke was, I think it was within a couple days of the election being over. And I was asking you to speculate on what you thought the market was going to do and how these larger kind of recaps and DSO purchases and the whole temperature of the acquisition environment was going to change with the new election. What have you seen since, in the very short period of time that the new administration has taken over as far as deal flow and the overall kind of
private equity was definitely rooting for Trump to get elected. They felt like the economy under Trump would perform better and he would press the Fed to reduce interest rates. And we're talking about private equity-backed DSOs. Most of them carry a significant amount of leverage. So the interest rate environment definitely plays a major role in their buying behavior, both from a demand and valuation perspective. It's played out as we expected in the sense that, we saw multiple recaps of medium to large DSOs in Q1 of 2025. And I know of at least 6 or 7 DSOs that are currently on market, a couple of which have accepted offers, a couple of which will accept offers over the next 30 days or so. So I think we're going to see more recaps announced over the next 3 to 9 months. And I think the optimism has returned to the marketplace in the sense that we're now in a declining interest rate environment. I know the market's been obviously a little choppy as far as treasury rates and the stock market recently, and we can talk about how private equity views that in a minute. But we've seen a lot more optimism in the DSO space than we've seen previous 18 to 24 months. That said, DSOs are being more diligent about evaluating the assets that they're acquiring. So they're being a little bit more selective. And the reason being is we're now, 5 to 7 years into mass consolidation of our space. And we're at a point where a lot of the founders are starting to exit their businesses. We're at a point where some DSOs have taken their licks and learned from their mistakes. So therefore, they're being choosier about what they buy and what they pay. And they're also being scrutinized by the institutional investors on the back end. When they go to recap, they're scrutinizing practice by practice. Should you have bought this practice? Were you mindful in your deal structure? Were you mindful in the valuation? And what does same-store sales growth look like? Great, you acquired a lot of EBITDA over the past 5 years, but did you actually make the practices that you acquired better? Did you integrate and efficiently operate them? So it's been interesting to watch the buying behavior change over the past 12 months, and some practices that were widely sought after and highly valued in 21, 22, and 23 have become more difficult to sell. And the larger multi-doctor practices with minimal key man risk, younger providers, a younger founder, they've become the Class A asset that every DSO is looking to acquire.
Yeah, that's a great summary. So, a big talking point for people that are anti-consolidation, and there are podcasts that are dedicated to, just never sell to a DSO for the following reasons. Because you always can, and you're basically prepaying yourself for X number of years, and there's no such thing as a recap, or if it is a recap, it's a once in a lifetime thing, and it doesn't happen regularly. Those are some of the things that you hear. But I mean, just based on kind of some of the things that you reflected on just now, the difficulty of closing what was previously a Class A asset has become more difficult. That you have to jump through more hoops. You have to qualify in several different ways, superior to how it used to be in the past. So could you see a future where it gets harder and harder and harder, or do you think it's going to get to a certain point where there's only so many things that they can scrutinize a practice on, and you'll be able to sell one way or another to a DSO?
I think we're definitely at the paramount of peak diligence that DSOs are doing on scrutinizing the assets that they're looking to acquire. Deals are definitely taking longer to get to the finish line. And like you said, there's more hoops you got to jump through. DSOs are making sure they cross their T's, they dot their I's, especially if your practice reflects in some degree characteristics of maybe a deal they acquired previously that didn't go well. So I don't expect diligence to get harder. I don't expect deals to take longer than they are today, but I do think this is the new normal, that DSOs are going to take a more pragmatic approach to their buying behavior. And look, long term, I think that's a good thing. I think that's healthy for the future of the DSO space, because we've been through a little bit of a reckoning over the past 12 to 24 months with interest rates doubling, with the capital markets being as tight as they have been. I think the narrative that you alluded to, that recaps don't really happen and it's the stock has no value, that kind of played nice over the past 12 to 24 months because recaps were either delayed or muted. But the reality is we always go through market cycles, and it was a down cycle over the past 18 to 24 months. And I think we're headed pretty quickly to an up cycle. And I've been pleased to see the recaps that have occurred and those that are on the horizon come to fruition at good returns. And I think that's going to continue, especially given what's happening now with the volatility in the stock market and the fact that we could be headed towards a recession. Both of those things are positive for private equity, and I think positive for the dental space as well. Private equity identified dentistry a long time ago as an industry that is pretty recession-proof, pandemic-proof, recession-proof. And when things start to tighten, when the macroeconomic conditions start to get a little bit more challenging, PE looks to industries that have weathered those storms very well in the past. And dentistry, fits that bill. Also, when the stock market experiences a lot of volatility, investors pull money out of equities and seek yield elsewhere. Alternative investments, private equity is realizing exceptional returns, over the past 10 to 20 years. So you're going to see money leave the stock market and go into real estate and go into private equity. So I think that's going to fuel growth in all private equity backed sectors, including dentistry. And then if we do enter a recession, you're going to see pressure on the Fed to reduce rates, which again is a good thing for private equity backed DSOs that are heavily levered. So all of these economic characteristics are favorable, I think, in the immediate future for the DSO space and private equity in general.
That's an awesome summary. I appreciate that one too. So, tell me about what you're seeing as far as there were some notorious or a lot of people that kind of follow the space knew that there was a few recaps that were held up for a bit, and some very well-known DSOs were having a difficult time recapping. What happened in those deals? Did they finally recap? And do you have a feeling as far as why they couldn't get across the finish line for so long, or they couldn't find a
handful of those DSOs ultimately did not recap and are now in the process of kind of retooling their organization, retooling their management team, their operations, their integration, and they'll eventually likely either be acquired by a strategic buyer, an existing DSO, or they'll find a new financial sponsor that will buy the asset for, 8 to 10 times EBITDA, and then inherit that new infrastructure and that new management team, turn the green light back on and start growing again. I think the main reason that a lot of those DSOs were unable to recap or unable to recap at a financial outcome that their PE sponsor was going to be happy about is that they were in the business of aggregating EBITDA without actually integrating and operating the asset. And they got caught by the change in macroeconomic conditions before they could flip it to the next investor. I think they thought they could aggregate the EBITDA, then it would be the next financial sponsor's responsibility to actually integrate and operate the platform on a go-forward basis. And this just didn't happen in dentistry. It's happened across private equity in general. And when they went to recap the investment, the capital markets were tight, interest rates were elevated, and the institutional investors that looked to acquire those assets at recap scrutinized the performance of the underlying portfolio of practices, and it wasn't where it needed to be. So therefore, they either recapped at a muted multiple or their recap indefinitely went on hold. And then those that were built on a solid foundation that consistently invested in their infrastructure and the integration and operation of the practices that they acquired, they've been able to hit a successful recap once interest rates have started to soften and the capital markets open back up. But it's definitely a bifurcated market. I mean, there are DSOs out there that will not recap. They will end up being sold to a larger strategic player and folded under their umbrella. For example, Smile Doctors just acquired MyOrthos. That was not the plan from the onset by MyOrthos, but by default, they were essentially forced to sell to a strategic at an outcome that I don't think their doctors or investors were thrilled about. But now they're under the umbrella of a larger DSO that is rapidly approaching, their own recap. So it's a bifurcated market. And I think that's why it's so important that if you're going to look at monetizing your business in a DSO affiliation, you got to make sure you have strong representation and you create optionality and have perspective, because if you pick the right horse, you can do very, very well and see a very lucrative recap event and also enjoy continuing to own and operate your practice in part on an ongoing basis. You pick the wrong horse, you could lose your equity.
Mm-hmm. Yep. So true. So you see a ton of deals come across your desk. So what is the ripest fruit that the DSOs are looking for right now? If you could just give us back of napkin, hey, try to get to this capacity as far as number of operatories, try to get to this percentage of EBITDA, try to get to this actual EBITDA number. And then what else are they looking for? Can you just kind of break that down? I know I ask you this every time you're on, but it's worth noting because the things change subtly from time to time when we talk. We talk about every quarter. So
things absolutely do change, and they have changed pretty remarkably. We've noticed just over the past 12 months. So the assets that have been harder to move are single doc practices where the doctor's within, let's say, 5 to 7 years of retirement, and a super producer. Those practices have significant amount of key man risk as well as succession risk. And doctor turnover, in particular, founder turnover, is the Achilles heel of most DSOs. And that's been, I think, the crux of a lot of their down performance has been the ability to build in a succession plan in those practices where they have other providers step into the founder's shoe and have the business continue to thrive. The practices that are now considered Class A assets are typically large multi-doc practices where the owner is responsible for less than 50%, ideally less than 35% of overall production. They're located within a urban or suburban geography, growing revenue trends, growing EBITDA trends. EBITDA at 20% margin are higher, but keep in mind, if you get above about 28 to 30% margin, DSOs are going to be a little skeptical that your margin is sustainable long term. Whereas if you're on the lower end, a little bit under 20%, they're going to speculate that they can leverage their economies of scale to significantly increase EBITDA margins and buy down their multiple post-sale. But those are the assets where we're seeing a lot of demand and high valuations. And especially if you have younger owners, right? If you have a clear path to long-term sustainability from a provider perspective, that's going to make the asset, far more attractive to private equity and DSOs than that single doc super producer practice where the doctor is, nearing retirement age.
That's a great breakdown. So if you were to give kind of some advice to a young doc, I'm so blessed that I get to be surrounded by these young gunners, females and males, that are just building these mega practices, going from, 5 ops to 12 and then still maintaining this 20% EBITDA and still having enough energy and a borrowing capacity to go basically do it again. I have a few right now that I was just talking to this past weekend that have several 12 plus operatory practices that are sub 55% overhead. It's unbelievable. They get this formula and they run with it and they're able to reproduce it. So if you were to give advice to a young doc that was looking to kind of try to follow this trajectory so they could cash in on this DSO wave, maybe by, mid-career, say 12 to 15 years from now, what are they doing? Are they looking for a high growth area? Are they looking for a small practice that they could eventually triple in size? Should they go ahead and buy an underperforming 10 op practice and try to turn it around? What are some of the main things that you've seen as a successful formula for the docs that come across your desk and are now ready and a great target for DSO?
I love this question. I think one, you've got to figure out how you want to scale your business and do it very, very intentionally. In other words, if you're going to go out and scale a multi-site practice, are you going to utilize an acquisition approach or a de novo approach. I haven't met many younger entrepreneurial doctors that can do both well. And those are two very, very different things. You know, if you're acquiring practices, you kind of have to re-engineer underperforming practices with your systems, your people, your culture to get them where you want to take them. And that can be difficult. Versus de novo, you start at zero, but you immediately can develop your culture, your systems, and grow the business the way you want to grow it. So those are two very different things. And I would prefer to either see you utilize an acquisition strategy or a de novo strategy, not necessarily both. Efficiency is key. In other words, if you already own, say, a single site large practice and you're doing $2.5–3 million a year in top line revenue at a 20% EBITDA margin, every incremental dollar of revenue, because your fixed expenses are already paid, your EBITDA margin is going to be exponentially higher on each additional dollar of revenue once you pass $2.5–3 million in top line. So I'd much rather see you grow that business by $1 million or $2 million revenue, which may generate, $300,000 to $500,000 in additional EBITDA, as opposed to going out and buying $2 million practices. So make sure that the office or offices that you do own are operating at max efficiency before you start spreading yourself too thin and opening or acquiring other offices. If you are going to acquire other offices, I would encourage you to look for practices doing $1 million to $2 million that have EBITDA, that have $200,000 to $500,000 in EBITDA. You can buy that practice typically from a private buyer perspective at, let's say, 4 times EBITDA. Well, your business, if it's large and has EBITDA north of 500,000, is already worth 6 to 7.5 times EBITDA. You can go out and buy a practice for 4 times EBITDA. Overnight, you're essentially doubling your money. And if you can buy a practice that is on the precipice of a tipping point where you can implement your systems, maybe move a provider over there, go multi-specialty, whatever you want to do to grow the top line revenue and EBITDA, it could be a home run. But just understand that it's a different ball game to own 1 practice versus 3 practices versus 5 practices versus 7 practices. And you need to always evaluate those inflection points and look at when you may want to think about monetizing the business and utilizing someone else's capital and infrastructure to help you scale the business and grow. And then also just thinking on the personal side. I mean, if you've got a killer 1 location practice and you're taking home $1 million a year, be very, very careful about what it means to scale your business from there, because the incremental personal income is not going to substantially change your life. Like whether you make $1 million a year or $2 million a year, your lifestyle and your level of happiness is not likely going to change exponentially. But I can tell you that if you go from 1 practice to 3 or 4 practices, you're definitely going to have more stress.
The quality of your life significantly decreases for at least a period of time. I can tell you that for sure. I've lived it. And I've watched many other people live it.
Yeah. So just be mindful about all of that, how that impacts your personal life, your professional life, your financial life, and making sure that you scale intentionally. And less is more, sometimes, especially when it comes to operating efficiently. It's all about EBITDA. It's not about number of storefronts.
Mm-hmm. Yep. And that's an ego metric that a lot of people get sucked into, myself included. I remember, I got to 5 and I was like, I just got to get to 10. And then I ended up making bad decisions based on the singular kind of ego metric of how many storefronts, how many can I tell people at, the next conference that I go to that I actually have, and I got to 10. And I was like, 4 of these are like 5 operatory practices that are sub $1 million. This isn't awesome. The amount of effort that it takes to keep these things afloat and slightly profitable is not worth the squeeze, right? And I see it happen over and over and over again. Look, just for content, I hate to ask this super amateurish question, but I'm going to ask it with a little bit of context behind it. So I'm sure that people, you bump into people at conferences and it's like, hey man, like what's the going rate? How much are DSOs paying as far as multiple of EBITDA right now? So like basically I'm going to do back of napkin math. Like my practice has got $200,000 or $250,000 in EBITDA. What's the multiple that I could get for this? What I'd like to do is wrap that up into, in this 5 to 7 year aggressive consolidation wave that we've experienced in dentistry. What have you seen in the high ends and what have you seen at the low ends, the highs, the dips, and then
yeah.
where
So,
we are now?
I mean, pre-COVID, dentistry was an industry that private equity was definitely in the process of falling in love with. And you were seeing all practices trading, whether they had $200,000 in EBITDA, there was demand all the way up to practices with $5 to $10 million in EBITDA. And most of those practices were trading for somewhere in the 5 to 8 times EBITDA range pre-COVID. And then once dentistry rebounded faster than really any other healthcare vertical, and private equity was already falling in love with it coming out of COVID, private equity was head over heels with dentistry after it proved to be recession-proof time and time again, then pandemic-proof. And in 21 and 22, I would say the valuations and multiples really peaked, where practices were trading pre-COVID at 5 to 7 times EBITDA, post-COVID trading at 7 to 9 times EBITDA. So you saw about a 30 to 40% increase globally in practice valuations in the DSO world in 21 and 22. I think 2022 was our high watermark from a volume standpoint and from a valuation standpoint. I don't think valuations will ever go back to where they were in 21 and 22. And I want to make that point because we've had some clients that have been on the fence about selling today because they want to wait until valuations return to that level. I don't think they'll ever return to that level because I don't think we're ever going to see interest rates back at that level. And interest rates definitely have a major, major impact on valuations in the DSO world. So over the past, I'd say 18 to 24 months, multiples have come down probably about a turn. And the reality was, even in 21 and 22, when multiples were at their peak, what we were seeing, let's say we take a practice to market utilizing a blind bid process and we get 10 offers. We would see a couple of offers that were way under market. You throw those in the garbage. We'd see 5 to 6 offers, all in a relatively tight, reasonable range. And then you'd have these 1 or 2 unicorn offers on that practice at 8 or 9x. Those unicorn offers are no longer there. And those buyers that were paying those elevated multiples in 21 and 22 are not buying practices today because many of them are over-levered. So you don't see those unicorn offers in the marketplace anymore. Those DSOs that have been bidding consistently over the past 5 to 7 years, you haven't seen valuations from their standpoint change remarkably. They were high but reasonable back in 21 and 22, and they're right around still the same mark today. So they're still compelling valuations, but they're not these no-brainer 9, 10x offers unless you're a big multi-site platform with 3 million plus in EBITDA.
Oh God, that's such a good point. So let me ask you this follow-up question. Do you ever get a stack of offers like you just were talking about where somebody's offering an 8 or 9 that's a younger DSO and maybe a tried and true DSO is offering a 7 or an 8? Do you ever say, look, I'm worried about this high valuation because they're going to be over levered and your equity is at stake because this might not be the right horse to jump on because your recap might end up being 0 because of their business model at this point.
The advice we give our clients is, you want your DSO buyer to be wildly irresponsible in what they offer you, right? You want them to give you 10x, 80% cash at close, clean deal structure, no downside protection, no earnouts, no dilution provision. But then you want them to be as conservative as possible on every deal they do from that point forward to protect the value of your equity. So we do caution clients that if we get some insane unicorn offer, be careful, because this is likely how they're approaching the marketplace as a whole. And that means that your second bite of the apple may not come, or it may be severely muted if their buying behavior is super irresponsible comparative to a tried and true buyer that might be a little bit more conservative from a valuation perspective and a little bit more thoughtful from a deal structure perspective. Given that the second bite of the apple could be as significant as the first, you'd be better off selling to them and realizing a modest return on equity versus selling to the unicorn offer and losing the second bite of the apple completely.
Yes. Okay. Yeah. There's a nuance to that, man. It's got to be tempting to say, I got it. I mean, it's a no brainer, right? I got a 9 offered here and I got a 7 offered here, but what is my equity at stake with this unicorn offer? Yeah, there's a lot that goes into analyzing these deals. Millions of Americans skip the dentist, not because they don't want care, but also in large part because they don't have insurance. That's lost revenue, missed opportunities, and untreated dental problems that can pile up. Enter Clear and MemberZ, the game changer for dental practices. Design your in-house membership plan that keeps patients coming back, increases case acceptance, and grows your revenue. It's simple, seamless, and integrates directly with your practice management software, so you can focus on the best care for your patients and filling up your schedule. If you're a DSN member, you can get an exclusive 20% discount on Clear and MemberZ. That means more savings, more patient loyalty, and additional revenue. Just visit Clear, that's KLEER.com/partner/DSN to take advantage of this special offer and start building a stronger, more profitable patient base today. That's Clear.com/partner/DSN to make great care accessible to everyone with a membership model that patients and providers love. Okay, I'm going to take kind of the same question as far as the multiples and ask you to put that in context. So like we hear numbers all over the place. Like, okay, hey, you got a 7x, but the good news is you can expect a 4x on the multiple, on your retained equity in 3 years, 36 months, 4x, do the math. It's a no brainer. Where has that been and where are we at now? So what was the high water mark? And where are we at now? What's the reality of what you can expect for a conservative recap number?
Up until about 2022, private equity's goal in the dental industry was to realize a 1x return on equity for every year of their recap cycle. So if you had a 5-year recap cycle, you're looking at a 5x return on invested capital. And that was relatively easy to pull off when, valuations were muted to some degree because the industry was not heavily consolidated and interest rates were, virtually obsolete, right? We now model out a 2.5 to 3x return on invested capital over a 5-year recap cycle. We try to be relatively realistic and conservative with our clients. Now, that's not to say that if we're not at the table, some DSO may put an offer in front of you that projects out, a 15x return on capital in a 10-year window. Is it possible to achieve that type of return? It's possible, but highly unlikely. So if you're only a seller, if you get a 15x return on your, second or third bite of the apple, in my opinion, that is not a prudent way to evaluate whether you should affiliate with that DSO or not. Just understand that projections are often frothy. What actually happens is TBD. So we try to be very realistic with our clients. We model out one recap within a 5-year window at a 2.5 to 3x return, irregardless of what that DSO buyer says about their equity.
Got it. Okay. All right. That actually is great information, and that's an optimistic look at these things. Tell me this. What would you say to, you and I both know that there are some talking heads out there that are strictly anti-PE, anti-DSO, and So there's an ongoing argument that goes around out there, like the pros and cons of selling to DSOs, the pros and cons of getting in quote unquote bed with private equity. What would you say to the outspoken CPAs or talking heads that are completely anti DSO PE and say that it's never a good idea to sell to those types of organizations?
Yeah, I love this question because I think doctors should be skeptical of anyone who takes a one-size-fits-all approach to the marketplace. If you talk to anybody that says selling your business to a DSO is a no-brainer, every doctor with a business of a certain size should go the DSO route, I would be skeptical of that person. Mm-hmm. If you're talking to somebody that says absolutely not, it's a non-starter, irregardless of the fact that I don't know you or know anything about your practice, you should never sell your business to a DSO. But I do understand that it's a lightning rod topic in dentistry. It may surprise you to hear that quite a few CPAs actually refer their clients to us who are looking at going down the DSO route. You know, even though it's not in the best interest of their business as a CPA for a client to sell to a DSO, mm-hmm. because if you're a CPA and your client sells to a DSO, you ultimately lose that client.
Yep.
So that's another thing that I think you need to pay attention to is what is the motivation of the person on the other end of the phone, right? If it's not accretive to their business, are they giving you objective guidance? And a lot of CPAs are trying to protect their book of business because their largest clients are being poached by DSOs. Mm-hmm. But there are some forward-thinking CPAs who understand that if their clients are going to go down the DSO route, it's best that they have proper representation, they create optionality, and they ultimately maximize their outcome. And we work with a lot of CPAs that understand that. I think it's also important to understand when you have a practice of a certain size, the private buyer pool is relatively limited.
Yeah.
And to say that it's like super easy to do internal succession planning and sell a $5 million practice to 5 different associates, to say that that's simplistic is just a falsehood.
That's right.
We see, the more complicated those deals are, the more people involved, the more likely they are to fall apart. So it can be very, very difficult to do internal succession planning for a large multi-million-dollar revenue practice. And even if you can pull it off, it's going to trade for a much lower valuation. Mm-hmm. I think also, unfortunately, CPAs tend to treat people like spreadsheets rather than treating them like people. Mm-hmm. Yes, the economic conversation is important. We need to talk about alternatives. Does a DSO sale make sense? If so, what do the economics look like? Does a private buyer sale make more sense? Does it make more sense to just keep your head down and retain ownership of the business? But you've got to take a holistic approach to the conversation because every doctor has certain things that get them out of bed in the morning, get them excited. They also have certain things that they lose sleep over. Mm-hmm. And you've got to get to know them, get to know their business, get to know their goals, their fears, their objectives, and take a holistic approach to evaluating what makes the most sense, mm-hmm. aside solely from the economic consideration.
Yep.
We see a lot of these talking heads and CPAs out there that say private equity is making so much money on the backs of dentists. But then in that same conversation, they'll say that the equity component of these deals is worthless. Mm-hmm. Well, those two things are mutually exclusive. Yeah. Private equity can't be making a killing by building DSOs and selling them at recap and then simultaneously be losing money on the equity component.
Right.
It's one or the other. But I will say there's some DSOs that are going to do remarkably well and have an outsized outcome on the back end when they go to recap. There are other DSOs that will fail and all other outcomes will be somewhere in between. So I think choosing wisely, should you go down this path in the first place, and then who should you partner with and what is the probability they're going to get to a recapitalization event with a handsome return? Those are all important considerations. I think it's also interesting that CPAs tend not to talk about the tax arbitrage associated with monetizing your business in the DSO space. When you sell your business to a DSO or affiliate with a DSO, you are essentially trading future income, right? Mm-hmm. Future EBITDA,
yep,
taxed at your highest tax rate, ordinary income tax. You are converting that future income into a capital gain. Mm-hmm. So there's massive tax arbitrage there. It could be a 20% savings by converting that future income into a capital gain. And capital gains taxes are as low as they're ever going to be. They're only going to go up likely in the future as the Fed needs to raise money. But it's funny that we don't hear CPAs talk about that very often. So I think it's not a one-size-fits-all approach. You've got to take a holistic approach to getting to know the person, quantifying what their goals are, taking a look at the economics, and you need to do it in an objective manner because in reality, anytime a client comes to us, there's essentially three options, right? Option one is to do nothing, to just continue on the course that you're currently on. Option two is to pursue a private sale to another clinician, a traditional practice sale model. Option three is to go the DSO route. Mm-hmm. You may choose to go option one for a while and then pivot to option two or option three at the appropriate time. We try to take the long approach in our business. And I think that's another narrative. A lot of people say, well, there's no way a broker is going to give you objective guidance. There's no way a sell-side advisor is going to give you objective guidance because they only get paid if and when you sell your business. That's like me saying that a dentist cannot be trusted to give an accurate treatment plan to a patient because they only get money. They only make an income if they overdiagnose and do all the dentistry today. No. Just as all of you listening have built your practice by being good stewards of the care of your patients, we've done the same in building our business. We take a very objective approach. We play the long game, and we know that if we give our clients good, sound advice, if and when it's time to monetize the business, they're going to call us and they're going to utilize us to help them, crush the outcome. There's no incentive for us, in my opinion, to play the short game. And that's how we've built the company. That's how we've built the reputation. And that's why we have the client testimonials, the reviews that we have.
Yeah. And I do think that there is this urban legend that recaps don't exist. And we hear that a lot from, I hear it from CPAs. I hear it from, wealth advisors, financial advisors. I hear that a lot. And we have lots and lots of evidence that they actually do exist. They have the recaps slowed down over the last couple of years. Yes. But the good DSOs actually do recap, and those numbers are actually real. There's a few things that I think about, and listen, like a lot of the argument that I hear out there is 100% correct for a certain batch of people, right? So if you are, there's never an argument that you are getting prepaid your profit for say 3, 4, 5, 6 years, maybe 7 years on the high end. And that's either good or bad, but nobody argues that, right? So that's just a given. There's no argument there. Like if you're getting 3x or 7x on your EBITDA, you're getting prepaid for 3 to 7 years. Everybody agrees with that. The argument comes from my perspective, from my own personal experience. I had 2 back surgeries, dude. And like, if I was a primary provider and I was killing it, if I was slaying it and I was doing $300,000 of production per month, the vast majority of the value from that particular practice was coming from me. And that went to 0 when I had my second back surgery, right? So there are inherent risks. What if your primary provider, or 2, either has carpal tunnel or a neck issue or gets sued for sexual harassment in your practice? There are inherent risks baked into a multiple provider model that they're not taking into account. If you could get prepaid for 7 years, you take those risks off the table, right? And you're able to focus on whatever you want to focus on. You can reallocate that windfall and you can put that to work for you, or you can just have, the peace of mind knowing that for the next 7 years, you're going to get paid regardless of what happens in that practice, right? Of course, you're going to have some triggers that are going to maximize that second payment and all that stuff. Those things are important to consider. But, there are risks inherent with owning a practice over the next 3 to 7 years that they never talk about. I love the fact that you're talking about this tax arbitrage, because that's also another thing, right? So you're getting taxed on this, 3 to 7 year windfall at 20%, right? And if you're in the 37% tax bracket, which no matter how many times you try to use tax mitigation strategies, you're getting taxed at a higher rate than 20%. Let's be honest. So we're not talking about that, 37 minus 20%, which is a 17% tax arbitrage that you're taking advantage of. It doesn't have to be black and white. So the arguments that they make are completely right with a certain segment of the transition population. But I mean, you have to customize your advice to each individual's particular, experience and where they are in the life cycle of their career. So I don't think that what they're saying is wrong for a certain segment of the dental population, but I mean, you got to open your mind up to different options for people's different situations. That's just the way that I see it.
Yeah, absolutely. I mean, look, if you've got a practice with top line revenue of 1.2 million, it's probably not that compelling to go the DSO route.
Right.
If you're 38 years old and you plan on practicing at this location for the next 20 years, it's probably not that compelling to go the DSO route. Mm-hmm. But if you're 50 years old and you own a practice with top line revenue of 5 million, it makes a lot of sense to at least explore the opportunity. Yeah. It's not a one size fits all approach, and anybody that takes the stance that it is, I would say has an ulterior motive, and it's probably self-serving.
Yeah. That's so good. I'm so glad you did that. I'm so glad we talked through that, because there are a lot of very, very rigid opinions out there when it comes to transitioning, getting involved with DSOs. And that's another thing that you and I didn't even talk about. You have to pick the right partner, because all of the bad things that they talk about, what could potentially happen to you when you transition to a DSO, where they're mandating the type of procedures that you're doing, or, the hours that you're working, or they have too heavy a hand on your supplies or your labs, or all the things that we hear about where you lose your autonomy. That only happens if you pick the wrong partner. Those are the sorts of questions that you need to have a checklist and make sure that that's part of your, vetting of the right partner. This is a very, very important decision on who you choose to take over this baby that you either birthed or you adopted. It's a huge, huge decision. So that's on you and your advisor to help you select the right partner, to make sure that the scary stories that you hear aren't actually going to happen to you if you're actually producing and you're bringing your best to the table like you do every day as an owner.
Yeah. Fit and deal structure are equally, if not more important than the initial valuation. Those two things are what is going to determine your happiness long-term, mm-hmm. right? Normally when people have remorse about going down the DSO path, is because they chose the wrong partner, or they chose the wrong deal structure, or a combination of the two. And I think that's why, optionality is so important. You need to be in a multiple offer situation so that you have perspective, mm-hmm. and that you have the opportunity to choose the right partner, rather than by default sell to the DSO that your buddy sold to, or that your, CPA or attorney or equipment rep, told you to call. Mm-hmm. And a lot of that comes down to, what are your goals, short-term and long-term? And is that particular DSO positioned to help you accomplish those goals? Mm-hmm. There are bad players in the market. There are bad deals out there. And you need to make sure that you protect yourself from going down the wrong path. And that's a big part of what we do, is to provide our clients with as much optionality as possible, and do the vetting before the buyers are even allowed in the room, so that we don't allow those bad actors in the room. And if and when a DSO treats us or one of our clients poorly, they're done. They'll never get another look at one of our practices again. But we've been pretty diligent. Over 200 DSO affiliations completed, and all of our clients, knock on wood, we've protected the value of their equity, and they've made good decisions as to who they partnered with, and they sold at the right time. And I will say this, we do about 400 practice valuations a year. I would say about half of those are on the private doctor-to-doctor side of our business, and about half of those are on the DSO side of our business. We will transact about 35 to 40 deals in the DSO space on an annual basis. So I'm doing 200 valuations annually and only taking, 30 to 40 practices to market. That's because for more than half of the valuations we do, a DSO sale is either not the right fit or it's not the right time. So, taking that long-term approach, getting objective guidance, and then making sure that you've got a strong team of advisors if and when you pull the trigger so that you follow the proper cadence and you don't make a mistake is critical to making sure that you're happy not just at close, but 3-5 years later.
So good. Such good advice. And I would challenge anybody, not challenge, but I mean, this might help your peace of mind a little bit. If you go out and, say you're a practice owner and, you have a $5 million practice, and I would just go out to a bank and say, could you pre-qualify me for, this other practice down the street that I want to purchase? Say it's a $3 million practice. Even if you have zero debt and you have this huge asset of $5 million, you're still going to struggle from the major banks to get a $3 million loan to acquire a practice. So that's just going to show you, it's going to give you proof that there is a limit to how much a private buyer is going to qualify for. And I will also secondarily attest to the fact that I've had a handful of associates buy me out of a larger practice, and I didn't go the DSO route. And you are absolutely right. It's not impossible, but it's not easy either. Each individual person has to get qualified. You all have to make sure that you're all in the same kind of headspace, share the same philosophies. Just because they work as associates for you doesn't mean that all of your associates are going to share the same philosophies and be good partners with you and then eventually be good stewards of the practice once you're gone. It could end up being a shit show with, 4 or 5 people that it takes to qualify to purchase a large practice because they can't qualify for anything more than $1.5 or $2 million. It's just something to think about. And I've been there, and I've counseled a lot of people through an associate buyout, and they're not impossible, but they're definitely complex.
I want to mention something along those lines. So a phenomenon that we're seeing more and more in the marketplace is large practice owners who look to do some internal succession planning or, have their primary producers buy into the practice so that they can retain them long term and they have skin in the game. Well, then it comes time for the founder, the senior partner, the majority owner to eventually exit their equity. And the relationship up until that point has gone great. Everybody's gotten along.
Yeah.
But when they're ready to exit and monetize their equity, oftentimes we see the associates and or minority partners behave really, really poorly.
Yes.
And either want to buy them out for under market valuation or block a potential DSO affiliation. So if you're planning to do internal succession planning, you better be very clear about your ultimate goals as to when you want to exit your remaining equity and how you want to exit it. Because irregardless of how the relationship has gone up to that point, it can go sideways really, really quickly when they know you're about to sell off into the sunset.
I have seen often, many times, an associate come in. And listen, a bunch of associates listen to this podcast as well, obviously, thousands probably. But I've seen associates come in and overvalue the value that they've brought to an office. And I've also seen them undervalue the value of the founding doctor and what the risk and liability it took to put that practice in place. Now, of course, I've seen lots of people that were completely reasonable and they understood like, hey man, you started this from scratch, 25 years ago. There's a premium that comes along with that and you should be compensated for that. But a lot of times I've seen people come in and not really understand because they've never founded a practice before, or they've never acquired a practice before and turned it, 4x'd it before. They've minimized the value of the founder. And I've seen them exaggerate the value that they brought to the practice. So that's just another thing that I've seen happen many, many times.
Absolutely.
Yeah. So Brannon, thank you so much, dude. This was a great episode. As always, you brought some really, really great information and perspective. I really appreciate chatting with you about these things. We align on a lot of our philosophies. What are the next steps if people are interested in getting that valuation? You do 400 of them a year. Is that the best way to start with engagement with you guys?
Yeah, we always start with a casual, confidential discovery call with me, 30-minute call just to get to know each other. Learn a little bit about your goals, where you're at in life, professionally, personally, learn a little bit about your practice, and then decide, does it make sense to do a deep dive? Does it make sense to do an EBITDA analysis, to do evaluation? And we typically do that from both a private buyer perspective and a DSO perspective. And we can do some economic modeling to show you under certain assumptions, how would it play out if you just kept your head down and eventually sold to a private buyer versus going the DSO route today. Mm-hmm. So I always give out my cell phone. I mean, all I do all day long is talk to large practice owners and do these discovery calls and have an awesome team of people behind me that supports me from a valuation and go-to-market perspective. But you can text me to schedule a call, 512-660-8505. You can email me, Brannon, BRANNON @dentaltransitions.com. And I encourage you to go to the website, dentaltransitions.com. We've got a lot of podcasts and webinars and content just like this because we're all about get educated, right? Get some objective guidance, start early, plan the process and try to reverse engineer whatever outcome you're trying to get to. So it's always great to be on, Mark. You've got an amazing audience that follows you, and we're here to be a resource. So please reach out if you'd like to schedule a discovery call and start a conversation regarding eventually, maybe not today, but eventually monetizing your business.
Awesome. Great conversation. If all else fails, dude, what a great URL. You could sell that thing. I mean, I can only imagine what that URL is worth. You guys lucked out by getting that. I appreciate you, man. Hopefully I'll see you soon in person. And I'm positive that we will have a follow-up call, hopefully within the next quarter.
Awesome, man. Take care.
All right, ladies and gentlemen, Brannon Moncrief. Hey, Doc, have you decided that 2025 is going to be the year that you take your practice, your health, and your personal and professional relationships to the next level? Well, here at the Dental Success Institute, our simple yet concise mission is to help dentists achieve their full potential in business and in life. If you've previously looked into the DSI programs, you know that we are the most comprehensive performance coaching group in our profession. Our members' results speak for themselves with an average of 38% top-line growth, 17% reduction in overhead, 49% profitability increase, and a decrease in 1.5 clinical days per week. I'm excited to announce that we've introduced 2 new tiers to our coaching platform, which will allow dentists from all stages of their ownership lifecycle to access our incredible resources, regardless of your budget and ability to travel. So, Doc, if you're ready to commit to making 2025 your best year yet, just visit TrueDentalSuccess.com to get more information on all of the tiers and how DSI can help make the transformation you've always dreamt of a reality. And if you'd like to talk to me personally about your situation, my team can make that happen as well. This is your time. Take action today. TrueDentalSuccess.com. And that wraps it up for another episode of the Dentalpreneur Podcast. Look forward to reconnecting on the next episode.
Thank you so much for joining us today on the Dentalpreneur Podcast. Check out TrueDentalSuccess.com for full recaps of every show, a schedule of our live events, free video tutorials, and a whole host of practice building resources.